Bitcoin may become the new gold, but for the time being, institutional investors prefer the real material. According to a report released on Thursday by JP Morgan analysts, bank failures that started in March prompted professional traders to increase their exposure to gold in future significantly while reducing their involvement with cryptocurrencies. Although it doesn't pay interest, gold is less appealing when interest rates are high, even if it is seen as buffer against a future disaster. Additionally, the bank crisis raised the possibility that the Federal Reserve may delay rate hikes or possibly decrease rates, in addition to making a general financial crisis seem more likely. Although Bitcoin hasn't been around for very long, its supporters believe it possesses qualities comparable to those of gold, such as a restricted supply and a low connection with equities, which might make it a viable alternative to digital gold. Since early March, when regional banks began to falter, the token's price has increased by around 44% to $29,387. However, according to JP Morgan, big and small investors appear to have divided when deciding about asset to invest in. Money managers increased their exposure to gold futures significantly between March and the beginning of May, resulting in a net long position worth almost $20 billion. In the meantime, the quantity of gold held in exchange-traded funds, a representative of retail gold interest, increased just a little. The inverse trend has occurred in investor interest in Bitcoin. JP Morgan's analysis of Bitcoin future data suggests that money managers did not purchase the tokens, even as regular investors drove up prices. Institutions may be reluctant to use Bitcoin as a disaster insurance policy for a variety of reasons. One is the fact that Bitcoin has only been operating for 14 years and has never seen a serious banking crisis. Bitcoin outperforms gold despite the fact that gold prices may be erratic. Prices are still more than 50% below their November 2021 peak, despite the rise. More importantly, the experts point out that the United States is now engaged in a regulatory crackdown on cryptocurrency assets with unpredictable ramifications for token values. Regulators have attributed a portion of Silvergate Capital Corp. Regulators have attributed a portion of Silvergate Capital Corp and Signature Bank's collapse to their extensive commercial dealings with cryptocurrency firms, and federal officials have cautioned other banks against engaging in similar activities. While Bitcoin is in the crosshairs of Uncle Sam, it is difficult to perceive it as a heaven from the storm.